Money. In a world awash with money and credit, China is printing less of it. Why? Let's find out. Introduction. China's money supply growth rate has been dropping in recent years, especially in recent months. Think of the money supply as the fuel that keeps an economy's engine running smoothly. When there's plenty of fuel, the engine runs fast. When there's less, it starts to slow down. So, what's causing the slowdown in China's economic engine? Firstly, let's talk about the overall slowdown in economic activity. Picture China as a giant factory that makes goods for the world. In the past few years, this factory has faced some serious issues. The COVID-19 pandemic disrupted operations, causing supply chains to break down and reducing global demand for Chinese goods. Imagine trying to run a factory when parts are missing and orders are dwindling. It's tough, right? This slowdown has meant less demand for credit from businesses and consumers, leading to less money circulating in the economy. Next up is the government's efforts to manage debt. China has been on a mission to reduce the massive debts held by its corporations and local governments. It's like someone trying to pay off their credit card bills. They start spending less and paying more towards their debt. The government has tightened borrowing rules to avoid a debt crisis, which means banks are lending less and businesses are borrowing less, again reducing the money supply. Then, there's the real estate sector, which has been another significant factor. China had a booming property market, but to curb speculation and avoid a bubble, the government imposed strict regulations. Think of it as putting speed bumps on a fast road to slow down the traffic. These regulations, such as higher down payments and limits on property purchases, have slowed down real estate transactions. And since real estate affects many other industries, this slowdown has rippled through the economy, reducing overall activity and, consequently, the money supply. External factors play a role too. The global economy has been pretty uncertain lately, with trade tensions and geopolitical risks. Imagine trying to plan a long trip when the weather forecast is unpredictable. It makes everyone cautious. Businesses and investors in China have been hesitant due to these uncertainties, which affects their spending and investment decisions, further impacting the money supply. Lastly, export challenges have been significant. China's economy heavily relies on exports, but fluctuations in global demand have made it tough. Picture a shop that sells most of its goods to tourists. If fewer tourists come, the shop's sales drop. Similarly, when global demand for Chinese exports falls, it impacts the country's trade balance and money supply. In recent months, we've seen this trend continue. Monthly data from the People's Bank of China, PBOC, shows a consistent decline in the growth rate of money supply indicators like M1 and M2. It's like watching the fuel gauge in a car slowly drop, signaling that the engine might soon need a refill. So, to sum it up, China's money supply growth rate has been falling because of a mix of economic slowdown, debt management efforts, a cooling real estate market, global uncertainties, and export challenges. All these factors have come together to reduce the amount of money circulating in the economy, slowing down the economic engine. Understanding this helps us get a clearer picture of China's economic health and its ripple effects on the global economy. Key factors contributing to the decline. Alright, let's talk about the key reasons why China's money supply growth rate has been slowing down. Imagine you're running a business, and there are several factors that make you tighten your budget. That's essentially what's happening with China's economy. Economic slowdown first. There's the overall economic slowdown. Think of China's economy as a big, bustling city that suddenly gets hit by a severe winter storm. Everything slows down. People stay indoors, businesses close early, and less gets done. Similarly, after the COVID-19 pandemic, China's economy faced disruptions in supply chains and a drop in global demand for its products. When factories produce less, companies earn less, and consumers spend less, leading to a slowdown in the circulation of money. Regulatory and policy measures next. Let's talk about regulatory and policy measures. Picture the government as a strict parent who decides it's time for the family to start saving more and spending less to pay off debts. China has been on a mission to reduce the heavy debts of its corporations and local governments, which means putting tighter controls on borrowing. For instance, banks are now more cautious about lending money, and businesses are more hesitant to take out loans. This approach, while necessary to prevent a debt crisis, has also meant less money moving around in the economy. Real estate sector slowdown now. Consider the real estate sector. Imagine the housing market as a high-speed train that the government wants to slow down to avoid a crash. They put up speed limits in the form of regulations, higher down payments, limits on how many properties people can buy, and stricter rules for developers. These measures have cooled down the real estate market significantly. Since real estate affects a wide range of other industries, the slowdown here has a domino effect, reducing overall economic activity and the money supply. External factors. Let's not forget the external factors. The global economy has been a bit like a shaky bridge lately, with trade tensions and geopolitical risks making things uncertain. Businesses and investors in China are like drivers who slow down when crossing this shaky bridge. They become more cautious. This caution leads to less spending and investing, which means less money circulating in the economy. Export challenges. Lastly, there are the challenges in exports. Imagine China as a major exporter of goods, like a large store that sells products to international customers. When global demand for these products fluctuates, it's like having fewer customers in the store. This drop in exports affects the country's trade balance and, in turn, the money supply. So, what we've seen recently is a consistent drop in the growth rate of money supply indicators, like M1 and M2, according to the People's Bank of China, PBOC. It's like watching the water level in a reservoir steadily decrease, signaling that there's less available for use. In summary, the decline in China's money supply growth rate is driven by a mix of an economic slowdown, tighter regulations and policies, a cooling real estate market, global uncertainties, and export challenges. These factors combined have led to less money flowing through the economy, slowing down its overall pace. Understanding these reasons helps us see the bigger picture of what's happening in China's economy and its effects on the world. Recent trends and data. Alright, let's take a closer look at the recent trends and data on China's money supply growth rate. Think of this as checking the health stats of a patient to see how they're doing over time. Monthly data analysis. Imagine you're keeping track of your fitness progress. You measure your weight, your running speed, and how much you can lift each month. Similarly, the People's Bank of China, PBOC, tracks the money supply growth each month using indicators like M1, cash and liquid assets, and M2, broader money, including savings. In the past few months, the data has shown a consistent decline in these growth rates. It's like seeing your running speed gradually slowed down month after month. For instance, in some of the recent months, the M2 growth rate has dropped from around 8.5% to just above 7%. This might not seem like a huge difference, but in economic terms, it's significant. Year-on-year comparison now. Let's compare this year's data to last year's. Think of it like comparing your fitness levels this year to last year to see how much you've improved or, in this case, slowed down. If you look at the year-on-year growth rates, you'll notice a sharper decline. For example, if last year the M2 growth was at 10%, and this year it's down to 7%, that's a clear sign that the economy isn't growing as fast as it used to. Notable dips in key months. There have been some notable dips in key months. Imagine if you got sick or injured and your fitness levels took a noticeable hit in specific months. In the case of China's money supply, these dips often coincide with significant events or policy announcements. For example, when the government introduced new regulations to control debt, there was a noticeable drop in the money supply growth rate. These trends indicate that various factors are consistently putting pressure on the economy. It's like a series of small setbacks in your fitness journey that, when added up, show a clear trend of slowing progress. In summary, the recent trends and data paint a clear picture. China's money supply growth rate has been on a steady decline, with noticeable dips during key months. This trend reflects the cumulative impact of economic slowdowns, regulatory measures, real estate market cooldowns, global uncertainties, and export challenges. By understanding these data points, we get a clearer view of how China's economic health is evolving over time. Implications for the economy. Let's talk about what all this means for China's economy, and imagine it like the effects of a diet on someone's health and lifestyle. When you change your diet significantly, it impacts how you feel, your energy levels, and your overall health. Similarly, the slowdown in China's money supply growth has several important implications for the economy. Credit availability. Think of credit availability like the availability of food. If you suddenly start eating less, you might feel weaker and have less energy. In the same way, when there's less money flowing in the economy, businesses and consumers find it harder to get loans. This means companies might struggle to finance new projects or expand their operations, kind of like a runner who can't train properly because they're not getting enough food. This can slow down economic growth even more because businesses aren't able to grow and hire more people. Consumer spending. Next, consider consumer spending. When people have less money to spend, they cut back on buying things they don't absolutely need. It's like tightening your belt when your income drops. When consumers spend less, businesses earn less, and this creates a cycle of reduced economic activity. For example, if people start buying fewer cars, the auto industry slows down, affecting everyone from car manufacturers to steel producers. Investment activity. Investment activity is another critical area. Think of investments as planting seeds for future growth. If there's less money available, fewer seeds get planted. Investors might be more cautious, holding back on putting money into new ventures or expanding existing ones. This cautious approach can slow down technological innovation and infrastructure development. Imagine a farmer who, because of a drought, decides not to plant new crops this season. There will be less produce in the future. Overall economic confidence. Lastly, the overall economic confidence can take a hit. When there's less money circulating, people and businesses might feel uncertain about the future. This uncertainty can lead to even more cautious spending and investing, creating a self-fulfilling prophecy where fear of a slowdown actually contributes to one. It's like being worried about getting sick, and that worry making you feel even worse. In summary, the decline in China's money supply growth has several significant implications. It makes credit harder to get, reduces consumer spending, slows down investment activity, and lowers overall economic confidence. Just like a drastic change in diet affects your health and energy levels, this economic slowdown impacts all areas of the economy, leading to a cycle of reduced growth and activity. Understanding these effects helps us see the broader picture of how China's economic health is evolving and what it means for the future. Context of strategic competition with the U.S. How does this decline in China's money supply growth tie into the bigger picture of the ongoing competition between China and the United States? Think of it like two top athletes competing in various events. Each move one makes affects the other's strategy and performance. Trade tensions and economic decoupling. First off, consider the trade tensions. Imagine two neighbors who used to trade goods freely suddenly start putting up fences and barriers. The U.S. and China have slapped tariffs on each other's goods, making trade more expensive and complicated. For China, which relies heavily on exports, this is like a store losing a big chunk of its regular customers. It means less money coming in from sales, which in turn affects how much money is circulating in the economy. Supply chain realignments then, there's the effort to realign supply chains. Both countries are trying to reduce their dependence on each other, which is like two business partners deciding to work more independently. Companies are moving their production lines out of China to other countries, which means less industrial activity and investment in China. This shift has a direct impact on the money supply as businesses borrow and spend less. Technological rivalry. The technological rivalry is another big piece. Imagine two tech giants fighting for market dominance. The U.S. has restricted the export of critical technologies to China, like semiconductors. This is akin to cutting off essential supplies to a competitor, slowing down their ability to innovate and produce. For China, this means slower growth in high-tech industries, which are crucial for economic expansion and money flow. Investment limitations. On top of that, the U.S. has limited Chinese investments in strategic sectors. Think of it as blocking a competitor from investing in new tools and equipment. With fewer opportunities to invest abroad, Chinese companies have less capital flowing back into their economy, further squeezing the money supply. Financial sanctions and market access. Financial sanctions are another hurdle. The U.S. has imposed sanctions on Chinese firms, especially those in technology and defense, which is like freezing the assets of a rival. These firms find it harder to access international financial markets, reducing their ability to raise funds and invest. This restriction means less money flowing into the Chinese economy. Strategic fiscal policies. Lastly, consider China's shift to focus more on domestic consumption. This is like a business deciding to focus more on local customers after losing international clients. The government is encouraging people to spend more at home to reduce reliance on exports. While this is a sound strategy, it takes time to shift gears, and in the short term, it affects the overall money supply. In summary, the strategic competition with the U.S. has added layers of complexity to China's economic challenges. Trade barriers, supply chain shifts, technological restrictions, investment limitations, and financial sanctions, all these factors are like hurdles on a racetrack, slowing down China's economic sprint. By understanding these dynamics, we get a clearer picture of how global strategic moves are impacting China's economy and its money supply. Conclusion. So, let's wrap up what all this means in a straightforward way. China's money supply growth rate has been falling, and it's a bit like watching a once booming city slow down. Picture a bustling market that gradually sees fewer shoppers, fewer stalls, and less activity overall. This slowdown isn't because of just one thing. It's a mix of several key factors coming together. First, there's the general economic slowdown, which is like a chilly winter that makes everyone stay indoors. COVID-19 hit hard, disrupting everything from factories to international trade, causing a drop in production and spending. When businesses and people spend less, there's naturally less money moving around. Next, the government's debt reduction efforts are like parents deciding to cut back on expenses to pay off the family's credit card debt. This means fewer loans and more cautious spending. While it's good for long-term financial health, it slows down current economic activity. Then, we have the real estate sector, which has been intentionally cooled down by the government to prevent a bubble. Imagine a speeding train that's suddenly slowed down to avoid a crash. This affects not just property developers, but also many other related industries. Global uncertainties are like dark clouds on the horizon, making businesses and investors cautious. Trade tensions and geopolitical risks make everyone hold back a bit, leading to less spending and investment. Finally, the challenges in exports are like having fewer customers in a shop. If global demand for Chinese goods drops, it directly impacts how much money flows into the economy. All these factors together mean less money circulating, which impacts credit availability, consumer spending, investment, and overall economic confidence. It's a chain reaction. Businesses struggle to grow, consumers spend less, and everyone becomes more cautious. Understanding these reasons helps us see why the Chinese economy is slowing down and what might happen next. It's like reading the signs in a weather report to predict if we need to carry an umbrella. Knowing the why and how of these changes gives us a clearer picture of what to expect for China's economy and its role in the global market.